Hi everybody, it's Anthony Fletcher. Thanks for coming to my channel, A Lender's Point of View. Today we are going to talk about what is a debt to income ratio and why you need to know about this ratio requirement. Okay, so when a lender pulls your credit report, what they're going to do is they're going to look at the history of their credit report and also the monthly payments, the minimum monthly payments due. And they're going to add that to your new proposed housing payments. Plus, they're going to add a few other things if they show up on your credit show up in different other things, let's say on title reports and things like that. So let's look exactly what you're looking at. So the debt to income ratio is your total debts divided by the gross verifiable income. Okay? Now, when you look at it, there's certain debts that are not calculated into this thing. So let's look at these. The first one is your cell phone. Even though it might be $100 a month, we don't use it. Car insurance, we don't use that either. Utilities, like electric and gas or sewer, don't use that either. Cable, hospital payments, let's say you owe the hospital some money. Voluntary payments, let's say you pay some guy to do work on a regular basis on your lawn, you don't have to include that. And deposits into your savings accounts, and sometimes we use that as far as to show that you have credit history, but we don't use that as a payment. So now let's look at the items that actually go into the two ratios on there. So not one, but two. Okay, the first one is going to be what they call the housing ratio. And your housing ratio is going to be your new mortgage payment, which includes the principal, interest, taxes, and insurance, and any homeowners association dues. So we're going to use that total payment divided by your total income. Now, the other ratio is going to be what you call your total ratio. And that's going to include the payments in the housing ratio plus other installment loans. Let's say you have another mortgage loan. Let's say you have a personal loan, something like that. If you have levies or garnishments, some legal issues or something like that, that's going to show up on there too. Child support, those monthly payments, and then credit cards. So that's going to total what they call your total ratio. So it's your housing ratio plus all these other items, which equals the total ratio. Okay, so those are your debts. Now let's look at your gross verifiable income. Now what's gross verifiable income? What is that between the gross income? Well, the difference between gross income and gross verifiable income is you may have money coming from all sorts of different sources, but if we can't verify that money you've been receiving that, and it's going to continue for 3 years, then we don't know if it's going to be there. And so therefore we can't use it in your income numbers. So let's look at what is eligible. So you've got work, for example. So if you have your normal job, dividends or interest you get from your, let's say from your bank accounts or from your investments. Interest, so like I said, like that for your child support. So if you get child support income coming your way, that's great. Pension, so if you get pensions, Social Security, other things. Let's say you've got a note due that someone owes you money, and they've been making payments to you for over a year, and it's going to last at least 3 more years. We can use that income. And then other things too. Let's say, for example, that you have investment trust income or something like that coming to you on a monthly basis. You can use that type of income. So now I want to show you a scenario about John and Jane and their situation and what type of ratios they're looking at. So John has a regular job and he receives $4,000 a month salary. And Jane has been working at her job for over 2 years, and she's got she works $20 an hour. She makes 40 hours an hour, plus she gets overtime. So her history over the last couple of years has shown that she's been making $3,500 a month. Now there's a way that we calculate that income, and we can go into that a little bit more detail on another scenario. But for here, we'll look at this. Now, in addition, John mows the neighbors' lawns every weekend, and he's been doing it for 10 years. And he receives like $1,000 a month, but it's all in cash, and we can't verify it. He doesn't bill out. We don't have checks or anything like that, so he does it all under the table. We can't use that income. And so then Jane babysits the dogs for the neighbors every Saturday and Sunday. Once again, they pay her in cash. We can't use that income either. And then finally, John just took a new bartending job, and he gets paid roughly $500 every weekend, but he just took it a month ago. And because it just took it a month ago and we only have a month's worth of history, we can't use that income either. So they're left with their income of $7,500. Now, let's look at their mortgage payment. Their new mortgage payment is going to be $2,200 plus HOA is going to be $2,250 total. Their total income is $7,500, so their housing ratio is 30%. Now, we're going to look at their total ratio, which is also, we're going to add into the car payment and the credit cards of $100 a month, and that's going to equal a total of $2,250. So, that's going to add $2,250 plus the $450 for a grand amount of $2,700. Sorry about that. And divided by the $7,500, that's going to give you a 36% debt to income ratio. Now, the important thing that you do know, that there's a lot of different programs out there, and different programs based off your credit and assets and things like that, you can actually go as high up as like 57% back end ratio. But if your credit's low, then that total amount of ratio that you can have starts dropping. So it's really important for you to talk to your lender up front and put all this together, so if you do need to work on something, you can get it ready to go, so when you're ready to put your loan in, it'll be approved. Thanks again for showing up my channel. I sure appreciate it, and we'll see you again on the next video. Don't forget to like and subscribe. Bye-bye now.